Now imagine you're running a business. When prices fall, your profit margins shrink or vanish. Nobody wants to invest in a future where asset values drop. Expansion plans get shelved, loans become burdens, and factories come to a halt. Deflation isn't just a financial hiccup, it's a breakdown in trust, motivation, and direction on a national scale. In simple terms, deflation occurs when average prices consistently fall, and the currency gains value over time. If you have $100 today, you'll buy more next month without doing anything extra. Sounds ideal, right? But in reality, this leads people to postpone spending because buying later is cheaper. That behavior crushes the supply chain, stalls cash flow, and slows every heartbeat of the economy. Deflation may appear as a blessing. Prices go down, and consumers can afford more with the same amount of money. But don't celebrate too soon. Behind this cheaper world lies a silent storm, dismantling economies from within. While inflation erodes purchasing power, deflation, ironically, robs us of economic momentum. This isn't just about temporary discounts. It's a chilling freeze that makes money more valuable than confidence. While the world scrambles to deal with inflation, another silent force threatens entire economies. Deflation. It may sound harmless. Prices are falling, right? But behind the cheaper goods lies an undertow strong enough to drown jobs, collapse businesses, and shatter social trust. Deflation is when money strengthens while the economy weakens. In times like this, survival and success don't come from luck, they come from understanding. If you're ready to learn what deflation really means, where it comes from, and how to protect yourself or even thrive through it, then this is the deep dive you've been waiting for. If inflation is an economic fever, deflation is a slow freeze. It causes consumers to hesitate, businesses to halt investments, and banks to fear lending. Deflation is the quiet assassin, not loud like inflation, but relentless in its erosion. To truly grasp its force, we need to go deeper into the roots of this phenomenon. Deflation doesn't just appear. It's the consequence of a tangled web of economic and psychological triggers. When an economy's lifelines, cash flow, trust, demand are choked, deflation becomes inevitable. Unlike inflation, which often stems from excess, deflation is born from contraction, and its first root lies in the lifeblood of any economy: money circulation. Shrinking money supply is a major trigger. When central banks tighten monetary policy or commercial banks stop lending, money dries up. After crises like the 2008 meltdown, defaults skyrocketed and banks went into defense mode. With no new loans, spending stalls, investment dies, and the economy begins to shrink. Money gains value, but transactions disappear. The second cause is falling demand. When people lose jobs, income, or confidence, they stop spending. A daily loaf of bread is replaced by instant noodles. New clothes become unnecessary luxuries. This collapse in demand crushes sales and forces businesses to cut prices, pulling the economy closer to a dangerous spiral. As demand plummets, supply, once projected on optimistic forecasts, sits untouched. Factories, farms, and vendors get stuck with inventory. With too much supply and too little demand, prices collapse. But lower prices shrink profit margins, and companies hesitate to reinvest. The economy enters a living dead state, active but devoid of momentum. Excess supply impacts raw material producers too. For example, if bakeries stop buying flour, farmers are stuck with crops. To offload, they slash prices, but too far, and they can't cover production costs. Even with cheap inputs, the supply chain begins to crumble. It's possible for everything to become cheaper and still collapse. Deflation isn't caused by a single event. It's an echo chamber of three forces: too little money, too little demand, and too much supply. Worse, these forces reinforce each other. People save, businesses cut, workers lose jobs, and the loop tightens. This is deflation's self-sustaining spiral, cold, quiet, and deadly. Deflation isn't a one-off wave. It's a swirling vortex. When people notice falling prices, their behavior changes fast. Why buy today when it's cheaper tomorrow? That logic spreads like wildfire. Spending halts, businesses stall, and the economy slows. It's not just about prices anymore, it's about lost confidence. And an economy that's lost faith is one running out of breath. As prices drop, businesses slash costs. First materials, then wages, and eventually, jobs. Inventory piles up, cash flow dries, and layoffs begin. Laid-off workers stop spending. The cycle tightens from buyer to seller, from worker to owner. Everyone retreats. and the economy contracts with every breath of fear. Even when companies trim every cost, they can't beat consumer expectations. Don't buy now, prices will fall. That mindset kills revenue. Meanwhile, fixed costs like rent, power, and insurance remain. Eventually, the only options are deeper cuts, temporary closures, or bankruptcy. The dominoes begin to fall. It doesn't stop at one sector. As manufacturing slows, transport, logistics, and services follow. Entire value chains contract. Banks grow cautious, markets freeze, and capital dries up. Without financial flow, businesses can't function. And so the economy's tissue, businesses, jobs, transactions, begins to rot, piece by piece. Even worse, deflation reinforces itself. The more prices fall, the more people delay spending, which in turn pressures businesses to cut prices further. And so the vicious loop begins. Prices drop, consumption drops, revenues drop, output drops, employment drops, prices drop again. Each turn of the wheel digs the grave deeper. This is the deadliest truth about deflation. It makes everyone freeze. Consumers hoard cash, businesses pause, governments wait, banks withhold. The whole economy becomes a stage where no one dares to move. But if no one acts, no one spends, no one invests, nothing moves. And in that stillness, collapse creeps in. If deflation is an economic chill, then recession is when the entire system freezes over. As prices fall too far for too long, the economy enters recession. Output shrinks, revenue collapses, unemployment soars. This is no longer about individual businesses. It's a systemic crisis. Consumers lose trust, investors flee, and companies fold en masse. A dark cloud covers everything, and a sense of helplessness begins to spread like a silent epidemic. This isn't just a financial downturn, it's a psychological shockwave that paralyzes movement, ambition, and belief in the future. Recession doesn't only attack financial health, it erodes social morale. You see friends losing jobs, businesses collapsing, prices dropping, but still unaffordable. Fear tightens its grip, and that fear becomes fuel for a deeper spiral. The economy becomes a sick body, without energy, without motion. The longer we wait, the worse it gets. The more we save, the more we shrink. Recession turns economic retreat into societal default. It becomes a way of life, one where survival replaces aspiration. When recession becomes uncontrollable, when recovery tools fail, we tumble into the darkest abyss, economic depression. It's not about months or quarters, it's about years of contraction. History remembers the Great Depression of the 1930s. Millions jobless, thousands of banks gone, and an entire generation haunted. Depression doesn't just break banks, it breaks the spirit of a nation. When nothing moves for years, progress halts. People grow up knowing nothing but scarcity. Dreams are postponed indefinitely. Think of a growing economy as a car on a freeway. Deflation is when the engine runs low on gas. Recession is when the car stalls. But depression? That's when the car flips over, crashes off-road, and rolls into a ditch. It's not a question of restarting, it's a question of rebuilding entirely. Mass layoffs, widespread bankruptcies, governments stretched to the limit, and societies gripped by despair. This is the economic equivalent of total breakdown. During a depression, even the most skilled and hardworking people can't find jobs, not because they lack ability, but because the system no longer produces opportunity. Businesses don't hire, investors don't invest, consumers don't consume. The economy becomes like a tree stripped of nutrients, incapable of blooming, incapable of growth, and without bold intervention, it withers. Slowly, quietly, completely. In such an environment, every decision becomes about survival, not progress. The worst consequence of depression isn't monetary, it's psychological. When a society is steeped in pessimism, apathy, and fear, even the best economic policies struggle to gain traction. Confidence, an invisible but critical pillar of any economy, vanishes. When people stop believing in tomorrow, in recovery, in possibility, then every spark of momentum dies. No policy, no stimulus, no bailout can revive a population that has given up. And that is what makes long-term deflation so dangerous. When deflation becomes a vicious cycle, no country can afford to stand idle. To prevent a full-scale collapse, both governments and central banks must act, not cautiously, but boldly. Combating deflation isn't about slowing things down, it's about injecting adrenaline into a lifeless economy. The key? Get money moving again. Not into vaults, but into the hands of the people. It's not just about liquidity, it's about restoring motion. When no one buys, no one produces. And when no one produces, no one survives. Intervention is not a choice, it's an economic imperative. The most powerful weapon a central bank has is monetary policy. During deflation, interest rates are slashed, often to zero or even below, to make borrowing almost free. Saving becomes less rewarding and spending becomes more attractive. At the same time, central banks purchase government bonds from commercial banks, flooding the system with money. This isn't generosity, it's oxygen for an economy gasping for breath. By freeing up capital, banks can lend more, businesses can invest, and consumers can start spending again. It's the first spark needed to thaw the economic freeze. When interest rate cuts aren't enough, central banks bring out their heaviest artillery: quantitative easing. This involves injecting newly created money directly into the financial system by purchasing not just government bonds but corporate debt too. This sends a loud message: we've got your back. Confidence slowly returns. With cheap, accessible capital, businesses regain the courage to expand, hire, and innovate. Consumers start seeing opportunity instead of danger. When liquidity flows freely, the gears of commerce can begin to turn again, and momentum replaces paralysis. But monetary tools aren't enough. Enter fiscal policy, the government's power to influence the economy through taxes and spending. In a deflationary climate, cutting taxes puts more money in people's pockets. Lower income tax allows consumers to spend and corporations to hire. But the real punch comes from direct government spending. Public projects like infrastructure, education, and healthcare ignite job creation, stimulate demand for raw materials, and send cash flowing across industries. When the government spends big, it fuels not just growth, but belief. Imagine a new bridge being built during deflation. It's more than concrete and steel. It's hope, it's momentum, it's visibility. That bridge employs engineers, truckers, welders, suppliers, each paycheck fueling someone's rent, groceries, or small business. Multiply that by thousands of projects, and you create a ripple effect that awakens entire regions. Government action during deflation isn't about charity, it's about revival. When people see cranes moving and jobs returning, confidence doesn't just grow, it roars back, and with it, spending, production, and progress. Deflation is as much about psychology as it is about numbers. That's why recovery requires restoring faith. When citizens see bold leadership, effective policy, and results on the ground, they believe again. When companies see demand returning and banks start lending, they expand again. When everyone sees others taking action, they follow. Combating deflation isn't just about printing money. It's about reigniting motion, trust, and shared forward momentum. It's a call for courage, collaboration, and coordinated action at every level. Deflation isn't just a problem for governments or corporations. It hits home: your wallet, your debt, your decisions. When money gains value, the advantage shifts to those who hold it. But simply hoarding cash isn't a strategy. You need a smart, proactive approach, not just to survive, but to get ahead. In times when the world freezes, those who prepare don't just endure, they lead. And your first line of defense is clear: eliminate debt. Because in a deflationary world, debt doesn't shrink, it grows heavier, more painful, and more dangerous with each passing day. In deflation, every dollar becomes stronger, great for savers, but devastating for borrowers. If you owe $10,000, that same amount will cost you more in real terms as prices fall. Interest payments become harder to manage, and income may shrink while your obligations remain. So prioritize paying off debt, especially high-interest and variable-rate loans. Simultaneously, build a solid emergency fund. Cash is king in deflation. It gives you flexibility, options, and power. With it, you can navigate hardship and seize investment opportunities that others can't afford. Liquidity isn't just safety, it's leverage. While volatile markets scare many, smart investors find refuge in high-quality bonds, particularly government securities. In deflation, preserving capital becomes more important than chasing high returns. Bonds offer fixed income, low risk, and liquidity. If you do invest in stocks, focus on companies with strong cash positions, minimal debt, and stable demand. Think essentials, not luxuries. And most importantly, don't panic. Emotional decisions destroy portfolios. In deflation, calm minds win. The people who stay rational, disciplined, and informed will not only protect their assets, they'll position themselves to thrive when the tide turns. Deflation isn't just an economic term, It's a warning about imbalance, hesitation, and the paralysis of fear. But within every crisis lies a chance to reset, refocus, and rise. Those who understand deflation deeply don't just brace for impact, they prepare for opportunity. They pay off debt, hold strong assets, stay liquid, and act when others freeze. When prices fall, courage rises. When trust erodes, wisdom matters. You don't need to fear deflation if you're ready. Because in every collapse there's a clearing, and in that clearing, leaders are born. Be one of them. Start now.